You don't have a $300 a day problem. You have a professional versus amateur problem. And until you fix the identity crisis happening every morning when you sit down at your trading desk, no amount of technical analysis, chart patterns, or market strategies will save your account from inevitable destruction. Here's the brutal truth that will save your account if you let it penetrate your thinking. The market doesn't pay salaries. It never has, and it never will. The market is not your employer. It doesn't care about your rent, your car payment, or the fact that you promised yourself you'd make $6,000 this month. The market pays those who wait, those who size correctly, and those who cut losses fast without negotiation. If you woke up this morning thinking, I need to extract $300 from the market today, you've already lost. You lost before you opened your platform. You lost before the opening bell rang. You brought a desperate employee mindset into an environment that punishes neediness with bankruptcy. Most traders arrive at the markets from the corporate world, carrying psychological baggage that becomes their destruction. In that world, there's a predictable relationship between effort and reward. You show up at 9, leave at 5, do the work, and 2 weeks later a paycheck hits your account. It's linear. It's safe. It creates an addiction to consistency that becomes toxic in trading. When you switch to trading, you subconsciously import this salary framework. You grab a calculator. You see 20 trading days in a month. You multiply 20 times $300 and convince yourself that discipline will deliver $6,000 by month end. The math looks clean. It feels achievable. Just $15 per hour if you work 8 hours daily. Then you blow up in week 2, sometimes week 1. This happens because you're trying to impose employment structure on a chaotic, probabilistic environment that operates by entirely different rules. Let me show you exactly how this mindset destroys accounts through 2 traders, both starting with $10,000 accounts, both wanting that 300 daily average. Trader A, the amateur, opens his platform at 9:30 am with a question that is pure poison. Where's my $300? This single question creates suffocating psychological pressure that turns rational analysis into desperate pattern recognition. He scans charts looking for his daily quota, not for genuine trading opportunities. The market opens choppy, no clear trends, no volume surges, no clean pivotal points. A professional would see noise and wait. But Trader A needs his 300. His brain starts hallucinating patterns. He sees a potential breakout in a range-bound stock and convinces himself it's his morning opportunity. He buys with oversized risk because he wants to capture a big chunk of his daily goal in one trade. The stock immediately reverses. He's down $150 in the first 30 minutes. Now the mathematics of desperation kick in. He's not just down $150, he's $450 away from his imaginary target. The gap is widening. The pressure doubles. He forces another trade, increasing position size to make the money back faster. He removes his stop loss just this once because he can't afford another hit if he wants to reach his quota. By Wednesday, he's not building a salary. He's down $1,200, desperately gambling to get back to zero. The $300 dream has become a $1,000 nightmare. Trader B, the professional, sits at the same desk, watches the same screens, trades the same $10,000 account. But his morning questions are completely different. What does the tape show me? Where is my edge today? What's my maximum loss if I'm wrong? He has no quota, no salary expectation for today. He understands the market as a stream of asymmetric opportunities, not a paycheck dispenser. When he sees the same choppy conditions that tempted Trader A, he makes a decision that feels impossible to amateurs. He does nothing. $0 for the day. And he calls it a professional outcome. Tuesday brings more sideways action. $0 again. Wednesday, a pivotal point breaks on genuine volume. The setup is clean. Risk is defined. He enters with conviction, not desperation. The trade works. He makes $450. Thursday offers another quality setup. $320. Friday is messy again. He waits. $0. His week, 0, 0, 450, 320, 0. Total, $770. Daily average, 154. Not 300, but profitable. More importantly, his account is intact. his psychology is stable, and his discipline is reinforced. Next week, when a real trend emerges, he'll have the capital and mental clarity to press it hard. The amateur has a quota. The professional has a process. This distinction determines everything that follows. Here's what kills most traders. They confuse outcome with behavior. They demand consistency of profit rather than consistency of discipline. They want predictable results on their schedule, as if price action cares about their bills or timelines. But the market is a mechanism for transferring wealth from the impatient to the patient. It rewards those who wait for their pitch and punishes those who swing at everything. Every day, the market runs a psychological test. It asks, are you professional or amateur? Will you trade your plan or your emotions? Will you respect your rules or your desires? The amateur fails this test by 10 am, forcing trades to hit quotas. The professional passes by doing nothing until genuine opportunity appears. When you chase 300 daily, you teach your brain that rules are negotiable. Every time you say just this, once I'll move the stop, or I'll hold longer to hit my goal, you're programming yourself for larger failures. The market punishes negotiable traders without mercy. The line you must burn into your consciousness is this: the market doesn't pay by the day. It pays by your discipline. It pays when you accept small losses without drama. It pays when you do nothing on boring days instead of forcing action. It pays when you take the A+ setup and hold through noise, because your analysis says the trend is intact. You want that $300 average? Stop trying to earn it today. Start acting like Trader B today. Because here's the paradox you'll discover: your current approach isn't just emotionally destructive. It's mathematically designed to fail. In the next few minutes, you'll see why your daily target pushes you toward oversized risk, unrealistic win rates, and inevitable blow-ups. You'll learn the hidden architecture behind a real $300 average, how risk management, position sizing, and loss control combine to build monthly income without forcing trades. But first, we need to run the numbers that most traders never calculate. Let's strip the emotion out of $300 daily and talk numbers like professionals. Because what I'm about to show you is the mathematical reality that destroys 90% of traders who chase this goal. It's not market conditions. It's not bad luck. It's arithmetic they never bothered to calculate before risking real money. You want $6,000 monthly. You have a $10,000 account. The amateur looks at these numbers and thinks, I need 3% daily returns. That sounds reasonable, conservative even, just 3%. But reasonable sounding and mathematically viable live in completely different universes. 3% daily compounded is world record territory. Let me walk you through what this actually demands, trade by trade, because the gap between your dream and reality is where accounts die. If you risk 2% per trade, that's $200 on your $10,000 account. Standard risk management, nothing heroic. To make $300 profit on a $200 risk, you need a 1.5 to 1 reward to risk ratio on every single winner. Sounds achievable on paper, but here's where the math starts devouring accounts. How many trades do you take daily? Most active traders take 4 to 6 setups, let's say 5. To net $300 with 5 trades at $200 risk each, run the actual numbers. If you win 3 out of 5 trades at 1.5 to 1 reward to risk, 3 winners times $300 equals plus $900. 2 losers times $200 equals minus $400. Net result, plus $500. That looks fantastic, until you realize it requires a 60% win rate with disciplined execution every single day. Miss that win rate by just 10%, dropping to a realistic 50%, and the math flips brutally. 2 winners times 300 equals plus 600. 3 losers times 200 equals minus 600. Net result, $0. String together a few days at 40% win rate, add slippage and emotional mistakes, and you're not at 0 anymore. You're down several hundred by Tuesday. Now your 3% target demands more risk, more trades, more psychological pressure. The reasonable goal becomes a mathematical trap. The professional looks at this equation and immediately sees the flaw. He doesn't start with how do I extract 3% daily. He starts with how much can I afford to lose and still survive long enough for my edge to compound. Professional math looks entirely different. Same $10,000 account, but survival first thinking. Risk per trade, 1% of account equals $100. Target reward to risk, 2 to 1 equals $200 per winner. Win rate, 50%, which is realistic for most sound strategies executed with discipline. Over 40 trades monthly, watch what happens. 20 winners times $200 equals plus $4,000. 20 losers times $100 equals minus $2,000. Net result, plus $2,000. 20% monthly return. Exceptional performance by any professional standard. But it's not $6,000. And this is the exact moment where amateurs reject the professional path and destroy themselves. They see that $2,000 gap and think, I'll just triple my size. Risk 3% per trade instead of 1%. Problem solved. This is where accounts explode. A $600 loss doesn't feel like 3 times a $200 loss. It feels like a punch to the gut. It triggers survival-level fear that hijacks rational decision-making. Your hands shake. Your judgment clouds. Every tick against you feels like impending disaster. When you're in a winner, you exit at the first hint of profit because you can't psychologically handle the idea of a $600 winner turning into a $600 loser. When you're in a loser, you freeze. You hold, hoping it comes back, because admitting a $600 mistake feels impossible. Within days, you stop following your plan entirely. You're not trading your system anymore. You're managing fear, and fear is the worst trading system ever created. I coached a trader who lived this exact nightmare. He had solid setups, decent timing, but was obsessed with making $1,000 daily on a $25,000 account. He was sizing huge, sweating through every tick, ending every month flat or negative despite his analytical skills. I gave him counterintuitive instructions. Cut your position size in half. He resisted violently. I can't hit my goals with that size. I told him his goal was process execution, not dollar extraction. He finally agreed to try for 1 month. The transformation was immediate. With smaller size, a $150 loss didn't trigger panic. He could cut losers instantly and move on. When he was in winners, he could hold through normal pullbacks, because the position size didn't create anxiety. His win rate didn't change at all. His strategy didn't improve. His psychology stabilized because the math allowed him to breathe. His monthly return tripled, not from better analysis or new techniques, from position sizing that eliminated fear and allowed proper execution of his existing edge. The professional protocol sounds boring, but it keeps you alive. Maximum daily loss, 2% of account. On $10,000, that's $200 total. Hit that limit, you're done. No exceptions. No one more trade to get even. You close the platform. Risk 0.5% to 1% per trade while building consistency. This feels painfully small. You'll watch moves and think I should be making more. Ignore that voice. It's the amateur trying to kill your account. Only increase size after proving 65% win rate over 50 trades minimum. You earn bigger size through demonstrated consistency, not wishful thinking. Here's the line that separates professionals from amateurs. Profit targets are dreams. Loss limits are survival. The amateur obsesses over how much he'll make. The professional obsesses over how much he'll lose. Here's the paradox that confuses everyone. Once you cap daily loss at $200 and risk $100 per trade, you wonder how you ever hit $300 daily. The answer isn't bigger size or more trades. It's understanding that your salary doesn't come from consistent daily profits. It comes from asymmetric days, the occasional $900 winner that pays for multiple small losses. But to catch those big moves, you need the hardest skill in trading. Jesse Livermore, perhaps the greatest speculator who ever lived, said something that most traders read but never truly absorb. It was never my thinking that made me money. It was my sitting. That single sentence contains more wealth-building wisdom than 1,000 books on technical analysis. Yet it represents the hardest skill in trading, because it requires you to do the one thing humans are psychologically designed to resist: absolutely nothing. Here's what separates professionals from amateurs at the deepest psychological level. Professionals understand that doing absolutely nothing is sometimes your highest paying trade. Not your most exciting trade, Not your most intellectually stimulating trade, but your most profitable trade when measured across the weeks and months that build your $300 daily average. The amateur sits down each morning carrying psychological baggage from the corporate world. In that environment, effort equals reward. You work more hours, you make more money. You dig more ditches, write more code, make more sales calls, and income follows activity. This employee programming becomes toxic when imported into trading because markets operate by entirely different rules. You see price moving on your screen, and your conditioned brain screams, "Do something." If I'm not clicking buttons, I'm not working. If I'm not working, I'm not making money. Everyone else is capturing these moves while I sit here like an idiot. This anxiety drives amateurs to scalp 15 setups daily, forcing trades where no edge exists, hoping sheer volume will somehow grind them toward that daily target. But here's the trap that bleeds accounts dry. In trading, more effort often equals more destruction. More trades mean more commissions eating your edge, more slippage on entries and exits, more decisions made under psychological pressure, more mistakes compounding into losses, more mental exhaustion that clouds judgment when the real opportunity finally appears. I tracked a trader for 4 months who was stuck in this high-frequency hell. 15 to 20 trades every session, solid technical knowledge, decent pattern recognition, working 12-hour days analyzing charts. His monthly net profit, after all that effort? $57. After commissions and the psychological cost of constant decision-making, he was essentially trading for free while destroying his nervous system. I gave him instructions that felt impossible. You're limited to 3 to 5 trades per day. Maximum. Each trade must be at a clear pivotal point with volume confirmation and defined risk. If you don't see your A-plus setup, close the platform and walk away. He resisted violently for 2 weeks. I can't make money taking 3 trades. I need volume to hit my goals. I told him volume without edge is just organized account destruction. Finally, he committed to the experiment. His transformation was immediate and dramatic. His monthly return didn't just improve, it tripled. Not because his analysis suddenly became magical, because he stopped forcing trades. He stopped chasing noise. He waited for the tape to show him genuine opportunity, then acted with conviction and proper position size. This is the mathematical reality behind that transformation, and you need to burn these numbers into your brain because they contradict everything you've been taught about consistency. The $300 daily average you want is almost never achieved by making $300 every single day. That's a salaryman's fantasy imposed on a probabilistic environment. Real professional income comes through asymmetric outcomes. Let me walk you through what a typical professional week looks like when building that monthly salary. Monday morning arrives. You're stalking a setup that's been building for days. The pivotal point breaks. You enter with disciplined risk, but volume dries up immediately. The breakout fails. You cut your loss instantly at your predetermined stop. Down $100. This is not failure. This is the cost of doing business when you trade with edge. Tuesday brings choppy, range-bound action. No clear trend. No volume surges. No clean pivotal points ready to break. The amateur is losing his mind trying to scalp the noise, buying highs and selling lows. You sit. You watch. You preserve capital. 0 trades, $0. This is a victory disguised as inaction. Wednesday offers one setup that looks promising on the open. You enter with proper size, but it reverses quickly. Another disciplined stop. Down $160. Now you're $260 in the hole for the week. The amateur is panicking, increasing size to make it back. You remain calm because you understand the mathematics of professional trading. Thursday changes everything. A key resistance level you've been monitoring all week gets tested with genuine volume. It breaks decisively. You enter with conviction, not desperation. The stock doesn't look back. It trends powerfully all day. Because you preserved both capital and mental energy earlier in the week, you can hold through normal pullbacks and even add to the position as it proves you right. You close up $1,100. Friday brings another small opportunity. You capture $120 on a clean scalp, or maybe you do nothing if conditions don't meet your criteria. Let's examine your weekly mathematics. Monday minus 100, Tuesday 0, Wednesday minus 160, Thursday plus 1100, Friday plus 120. Your total profit is $960. Divide by 5 trading days, $192 per day average. You built what looks like a salary, but you only had one major winning day and one small winner. The salary came from your ability to take small, controlled losses while waiting for the asymmetric opportunity that paid for everything. This requires a professional waiting protocol that sounds simple, but demands iron discipline. Each morning, before market open, identify 1 to 3 A+ setups maximum, not 10 possibilities, not I'll see what develops. You decide in advance what you're hunting. Each setup must meet specific criteria: clear trend structure on higher time frames, a well-defined pivotal point where a break would signal meaningful movement, volume patterns suggesting institutional involvement, and precise risk definition where you know exactly where you're wrong. If these conditions aren't present during market hours, you don't trade. No close enough trades. No maybe this will work gambling. Doing nothing becomes your active strategy, preservation of both capital and mental bandwidth for when genuine opportunity appears. The amateur feels crushing anxiety when not trading. Fear of missing out drives them into marginal setups. They watch other traders posting wins on social media and feel like failures for sitting idle. This FOMO is account poison. The professional rewrites that narrative entirely. Waiting becomes stalking. Think of the difference between a machine gunner and a sniper. The machine gunner sprays bullets in every direction, hoping to hit something through volume. Lots of noise, lots of ammunition wasted, low probability of hitting the actual target. The sniper lies motionless for hours, sometimes days. Controls breathing. Studies conditions. Waits for the perfect shot where probability and impact align. One bullet, one target, maximum effectiveness. Your capital is ammunition. Every trade is a bullet. The amateur sprays capital at every chart wiggle, hoping something hits. The professional waits for the shot where probability, risk-reward, and market conditions create overwhelming advantage. Here's the line that will transform your trading if you let it penetrate. The money is made in the waiting, not the trading. Waiting isn't passive. It's the active choice to preserve resources for moments when edge is genuine and substantial. When markets are choppy, they're literally communicating. There's no salary here today. Don't try to force one. Most traders don't listen. They try to carve a paycheck out of noise, then wonder why they end each week drained and down. You must preserve not just financial capital, but mental capital. Decision fatigue is real. If you spend 3 hours fighting messy action, taking 12 marginal trades, managing fear and greed through random price movement, your brain will be exhausted when the clean breakout finally appears. You'll hesitate. You'll doubt. You'll miss the trade that could have paid your month's rent because you depleted your psychological resources fighting noise. Professional waiting is offensive strategy. It's the approach of a predator conserving energy, so that when prey becomes vulnerable, you can strike with overwhelming force and precision. But waiting is only half the equation. Waiting gets you to the door with capital and clarity intact. Once that pivotal point breaks decisively and volume floods in to confirm your thesis, patience must end instantly. The moment the setup becomes real, defensive mode switches off and aggressive mode engages. You cannot be timid when the market finally offers you the check you've been waiting for all week. This is where your $300 daily average actually gets built, not through grinding consistency, but through the disciplined patience to wait for asymmetric opportunities, then the controlled aggression to maximize them when they finally appear. You have waited. You have stalked the setup for days, maybe weeks. You preserved your capital through Monday's choppy noise and Tuesday's range-bound frustration. You took Wednesday's small loss with discipline. You maintained both financial and mental resources for exactly this moment. Thursday morning arrives, and the pivotal point you've been monitoring finally breaks with genuine volume confirmation. You enter with 1% risk, $100 on your $10,000 account. The market immediately proves you right, moving decisively in your favor. This is the moment that exposes who you really are as a trader. The amateur feels adrenaline flood his system as he watches unrealized profit tick higher. $200, 230, 250. His brain immediately converts this into narrative. That's 2/3 of my daily goal. If I close now, I've almost hit my quota. I can relax for the day. But if I don't close, the market could reverse. I might lose it all. Take the money. Take the money now. So he sells. He banks his modest win and congratulates himself for being disciplined. He feels smart for 30 seconds. Then he watches, helpless and increasingly angry, as the stock continues trending for another 3, 4, 7 points without him. The move that could have paid his entire week becomes a forgettable snack. He took crumbs and left the feast on the table because he was trading his daily quota instead of trading the tape. The professional lives in a completely different psychological universe. When the market confirms his judgment, he does not retreat, he advances. The breakout working in his favor is not a signal to escape with small profits. It is a green light to scale in intelligently, with controlled aggression and systematic risk management. This is pyramiding, and it is the single mechanism that transforms patient waiting into substantial profits. It is how you turn a $200 winner into an $800, $1,200, or even $2,000 salary maker. Let me walk you through the exact mechanics, because this is where the architecture of professional income lives. You start with your $10,000 account and standard 1% risk per trade, $100 maximum loss. A clean resistance level breaks with decisive volume surge. You enter your initial position, risking $100 if your stop gets hit. The stock moves from $50 through the resistance level, pushing to $52 with sustained volume. The tape confirms what your analysis anticipated. Institutions are accumulating, buyers are in control. Now most traders simply sit and hope, treating their position like a lottery ticket. The professional asks a sharper question. Has the market just provided proof that my thesis is correct? And if so, how do I press this advantage without exposing myself to ruin? Here is how professional pyramiding answers that question with mathematical precision. As the move progresses and pulls away from your $50 entry, reaching 52, you add a second position of equal size. But you implement a critical risk management rule. With this addition, you move the stop loss on your entire position to $51, just above your original entry point. Examine what this does to your risk profile. On your first 100 shares purchased at $50, your new stop at 51 locks in $1 profit per share. On your second 100 shares purchased at 52, your stop at 51 risks $1 per share. The profit from the first position exactly offsets the risk from the second position. Your total account risk remains $100 despite doubling your exposure. You now have 200 shares working in your favor, but your maximum loss hasn't increased. If the trend continues, you are no longer positioned to make $200, you are positioned to make $400, $600, $800 or more as the move extends. The trend proves durable. The stock pushes through 55 on another volume surge. You add a third and final position of 100 shares at 55. Simultaneously, you trail your stops higher. The first position stop moves to 53, locking in $3 profit per share. The second position stop moves to 52, protecting break-even. The third position stop sits at 54, risking $1 per share. Your worst-case scenario if everything reverses completely: plus 300 on the first lot, 0 on the second lot, minus 100 on the third lot. Net result, plus $200. You have tripled your position size while actually improving your worst-case outcome. The stock continues its institutional accumulation, reaching 62 before showing signs of exhaustion. You exit all 3 positions into strength. Let's calculate the mathematical transformation. First 100 shares bought at 50. Sold at 62 equals $1,200 profit. Second 100 shares bought at 52. Sold at 62 equals $1,000 profit. Third 100 shares bought at 55. Sold at 62 equals $700 profit. Total profit, $2,900. If you had followed the amateur approach and sold your initial position at 52 for a $200 profit, you would have walked away feeling smart while leaving $2,700 on the table. That is the mathematical cost of timidity, when the market validates your analysis. This is the equation that builds professional income. You feed the winners and starve the losers. When trades move against you, you cut them instantly at predetermined stops for controlled small losses. When trades move in your favor with confirmation, you press them systematically while protecting accumulated profits through trailing stop management. I know exactly what your internal resistance is screaming right now, because I have heard it from hundreds of traders. But if I add at higher prices, I'm ruining my average cost. I'm supposed to buy low, not buy higher. That thinking is what keeps traders trapped in small wins and full-sized losses. Forget your average price. Your cost basis is an accounting fiction that has zero relevance to future profitability. The market does not know your entry price. It does not care about your cost basis. The only questions that matter are, is the trend intact? Is volume supporting continuation? Is momentum building or fading? Are institutions still accumulating? If the answers confirm your thesis, you must have the courage of your convictions. You are not predicting anymore. You are responding to proof. The market has just told you that your analysis was correct. Adding to confirmed strength is not chasing. It is aligning capital with validated opportunity. Let me share a transformation story from a trader I coached named David. Before we worked together, he was consistently making around $150 daily with single positions. Respectable profits, but no real acceleration toward his $300 target. He desperately wanted that monthly salary, but couldn't reach it without oversizing his initial entries and blowing up on the inevitable losers. I introduced him to pyramiding with strict risk protocols. His resistance was immediate and visceral. This feels reckless. I'm adding to positions that are already extended. What if they reverse? I explained that proper pyramiding is actually more conservative than single large positions because trailing stops protect accumulated profits. He committed to the experiment for 1 month. His first textbook execution came on a biotech stock breaking out of a multi-week base. He spotted the setup trading around $48, strong uptrend structure, clear resistance level, volume building as price approached the breakout point. He bought 100 shares at 48 on the decisive break, with a stop just below the level, risking approximately $100. The breakout held and accelerated. The stock pushed to 51 with sustained institutional volume. Instead of selling and congratulating himself on a $300 profit, like his old pattern, he added another 100 shares at 51. Simultaneously, he moved his stop on both positions to 49, effectively locking in $1 profit per share on the original position while risking $2 per share on the new addition. His net risk remained around $100. The momentum continued as earnings approached. The stock consolidated briefly near 53, then broke again on pre-announcement rumors. He added his third and final block of 100 shares at 54, raising stops on all positions to protect accumulated gains. He now controlled 300 shares with systematic risk management, protecting his downside. The stock gapped up on earnings and ran to 61 before showing exhaustion signals. He sold all 3 positions into the strength. His mathematics: first 100 shares from 48 to 61 equals $1,300 profit. Second 100 shares from 51 to 61 equals $1,000 profit. Third 100 shares from 54 to 61 equals $700 profit. Total, $3,000. If he had traded his old way, single entry, single exit, he would have made roughly $300 on the move from 48 to 51. Respectable, but forgettable. By pyramiding systematically, he captured $3,000 on the same pattern, the same stock, the same initial risk analysis. That single trade covered his losses for the entire previous month and established his confidence in the approach. This is the core psychological shift you must internalize. Your monthly salary does not come from grinding out consistent daily profits. It comes from maximum exploitation of the few occasions when the market offers genuine trending opportunities that you have the structure and courage to ride fully. But courage without systematic rules becomes reckless gambling. Professional pyramiding requires non-negotiable protocols that protect you from your own greed and overconfidence. Rule 1. Only add to winners, never to losers. If your initial position is not showing profit with volume confirmation, you have no business increasing exposure. Adding to losing positions hoping to average down is the fastest path to account destruction. You pyramid into proven strength, never into hope. Rule 2. Each addition requires fresh confirmation from the tape. You do not add simply because you feel optimistic about the trade. You add because the market is providing new evidence, renewed volume surges, continuation breakouts through secondary resistance levels, momentum acceleration, or institutional accumulation patterns. Each layer must be justified by new technical development. Rule 3. Trail stops higher with each addition to protect accumulated profits. This is what separates professional pyramiding from amateur gambling. As you add positions, your worst-case scenario must improve, not deteriorate. Earlier positions get protected by trailing stops, while only the newest addition carries meaningful risk. Rule 4. Maximum 3 additions to any single idea. Even the strongest trends eventually exhaust themselves. Professional discipline requires knowing when enough is enough. 3 layers typically capture the heart of most moves while maintaining position control. More additions often lead to becoming top-heavy, where small reversals eliminate all gains. Think of this like managing a business. Your winning trades are your star employees generating massive revenue. Your losing trades are bad hires stealing from the register. When you have a star performer who is crushing their targets, do you fire them after one good morning? No, you give them more resources and let them work. When you have someone stealing from you, you fire them immediately. Most traders do the opposite. They fire their star performers every afternoon by taking quick profits, while keeping their thieves on payroll for weeks by holding losing positions hoping they improve. Here's the line that must replace your fear of giving back profits. You cannot be timid and expect a professional salary. The market rewards conviction when backed by systematic process. When you have done the analytical work, waited patiently for your setup, and the market confirms your thesis with price and volume, timidity becomes a sin against your capital and your potential. This is exactly how you cover Monday's $100 controlled loss and Wednesday's $150 disciplined cut. You do not cover them by scraping together $20 wins from noise. You cover them by systematically exploiting Thursday's trending opportunity that runs for hours and pays for the entire week. This is the transformation from scared money to smart aggression. Scared money takes profits the moment any threat of reversal appears. Smart aggression understands that the pain of missing a substantial move far exceeds the pain of a modest profit giving back some gains. Your asymmetric weekly equation works like this: Monday lose $100 in a controlled stop-out. Tuesday make $0 waiting patiently for quality setups. Wednesday lose $150 on another disciplined cut. Thursday pyramid a genuine breakout for $1,200 profit. Friday add $200 on a smaller opportunity. Your weekly total, $750. Daily average, $150. Monthly projection, $3,000. That is how professionals build what appears to be a salary, not through daily consistency, but through maximum capture of asymmetric opportunities when market conditions align with patient preparation. But pyramiding is only the offensive component of professional trading. You also need a complete framework that integrates risk management, patient waiting, and systematic position building into a repeatable monthly process that generates consistent income over time. You need to understand how all these pieces fit together into a coherent blueprint that transforms sporadic big wins into reliable monthly cash flow. That comprehensive integration is where we turn next, the complete monthly salary architecture that brings everything together into a sustainable trading business. Let's bring this full circle and show you exactly how that $300 daily average gets built in the real world, not in fantasy spreadsheets or motivational Instagram posts. You want that $6,000 monthly salary. You want to look at your trading account the same way you look at a reliable paycheck. Here is how you actually build it, week by week, through disciplined process instead of desperate daily extraction. First, you must kill the daily obsession that is poisoning every decision you make. Your goal is not $300 today. Your goal is not even $300 tomorrow. Your goal is $6,000 this month through systematic execution of the professional protocols we have walked through together. This mental shift from daily targets to monthly process is not semantic wordplay. It is the psychological foundation that separates long-term survival from inevitable destruction. The professional understands something the amateur never accepts. You don't control your daily profit and loss. You control your risk, your behavior, your trade selection, your patience, your execution. The money is the consequence, not the target. So instead of a daily quota that creates desperation, you adopt a monthly architecture that creates calm confidence. Let me show you what a realistic professional month looks like when you trade with the discipline we have outlined. This is not the highlight reel. This is the grinding reality of how accounts actually grow. Week 1 arrives with mixed market conditions. You are disciplined, focused, and ready to execute. But the market opens choppy, with no clear directional bias. Monday offers a clean setup that you take with proper 1% risk. The breakout fails immediately. You cut your loss at $100 without hesitation or drama. Tuesday brings another setup that looks promising on the open, but reverses quickly. Another disciplined stop at $110. Wednesday, you wait all day. No quality setups appear that meet your criteria. You make $0 and call it a professional outcome. Thursday offers a marginal opportunity that you take with reduced size since it doesn't tick all boxes. You scratch out, closing flat after commissions. Friday delivers a small winner as a secondary stock breaks resistance with decent volume. You capture $160 with proper risk management. Your week 1 mathematics: 3 small controlled losses, totaling $210. 1 scratch trade at 0. 1 small win at $160. Net result for the week: minus $50. The amateur is now in full panic mode. I'm down $50. I'm behind my monthly target. I need to make it back fast. This desperation destroys week 2 through forced trades and oversized risk. But you remain professional. You understand that negative weeks are part of the statistical distribution when you trade with genuine edge. You do not change your process because of 1 week's outcome. Week 2 begins quietly. Monday and Tuesday offer no clean setups that meet your A+ criteria. You wait. $0 both days. The amateur is climbing the walls with anxiety, convinced he is missing moves and falling further behind his imaginary quota. You remain calm because you understand that capital preservation during unclear conditions is what allows you to strike decisively when real opportunity finally appears. Wednesday changes everything. A stock you have been stalking for 2 weeks finally breaks its pivotal resistance level with genuine institutional volume. You enter your initial position with $100 risk precisely at the breakout point. The move proves immediately valid with sustained volume, clean price action, and building momentum. As it pushes through the next technical level with confirmation, you add a second position while moving stops to break even on the first. The trend continues developing through the afternoon session. You add a third position on renewed volume surge, trailing stops systematically on all layers to protect accumulated profits. By market close, you have captured a properly pyramided winner for $970. This single trade, executed with patient preparation and systematic aggression, just paid for your entire previous week's losses, plus delivered substantial profit. Thursday and Friday offer 1 more small loss of $90 on a failed breakout, and 1 scratch trade where volume dried up. Your week 2 mathematics: 2 small losses, 2 $0 waiting days, 1 massive pyramided winner. Net result for the week: plus $780. Your month-to-date position after 2 weeks: plus $730. Not 300 daily yet, but the foundation is being built through process, not through forcing outcomes. Week 3 brings the psychological test that separates amateurs from professionals: choppy, range-bound, directionless market conditions that offer no quality setups for days at a time. Monday through Wednesday you sit and watch screens, taking 0 trades, making $0. The amateur is hemorrhaging psychological capital, convinced he is failing, desperately tempted to force marginal trades just to feel productive. You understand that doing nothing is your highest value activity when markets offer no genuine edge. Thursday offers 1 setup that meets most, but not all of your criteria. You take it with reduced size to reflect the lower probability. It works for a small $80 win. Friday brings another scratch trade where the setup looked good, but follow-through never materialized. Your week 3 mathematics: mostly disciplined waiting, 1 small win, 1 scratch. Net result for the week, plus $30. Your month to date after 3 weeks, plus $760. Daily average so far, approximately $50. Still nowhere near your 300 target, but you are preserving capital and maintaining discipline while waiting for Week 4's opportunities. Week 4 delivers what patient professionals wait for, trending market conditions with multiple quality setups appearing as broader indices break out of consolidation patterns. Monday brings a clean pyramided trade in the technology sector that you execute systematically, capturing $620. Wednesday offers another solid trend in healthcare that you ride for $490 with proper position building. Thursday and Friday are quieter, delivering one small loss of $70 on a failed follow-through and one scratch where you exit at break-even. Your Week 4 mathematics: 2 properly pyramided winners, 1 small controlled loss, 1 scratch. Net result for the week, plus $1,040. Your final monthly total: Week 1 minus $50, Week 2 plus $780, Week 3 plus $30, Week 4 plus $1,040. Monthly profit, $1,800. Daily average across 20 trading days, $90 per day. Not $6,000. Not even close to your original fantasy. But here is what you actually accomplished. You grew your account from $10,000 to $11,800. That represents 18% monthly return, which is extraordinary performance by any professional standard. More importantly, you achieved it through disciplined process that is repeatable and scalable over time. Now watch the quiet magic of compounding work in your favor. As your account grows from $10,000 to $11,800, your 1% risk per trade automatically scales from $100 to $118. Your position sizes grow proportionally. Your pyramided winners get larger without changing any risk management protocols. Continue this process with consistent execution. Month 2 with your larger account delivers similar discipline. $1,950 profit. Your account grows to $13,750. Month 3, $2,100 profit. Account balance now $15,850. By month 6, your account sits at approximately $18,000. Your 1% risk is now $180 per trade instead of $100. Your pyramided winners that used to generate $900 are now generating $1,600 on identical technical patterns. Your monthly profit potential has scaled to $3,500 through pure account growth and consistent process execution. By month 12, if you maintain this discipline without major mistakes, your account reaches approximately $28,000. Your 1% risk is now $280. Your monthly income potential ranges from $5,000 to $7,000. Your daily average legitimately approaches $300, not through forcing daily outcomes, but through 12 months of professional behavior that compounded your capital base systematically. To keep yourself on this path requires a daily checklist that acts as your professional conscience. Before market open, you review exactly 4 pillars that determine your success or failure. Risk management becomes your non-negotiable foundation. You swear an oath to never exceed your 2% daily loss limit under any circumstances. If your account is $10,000 and you lose $200, you close the platform immediately. No exceptions. No one more trade to get even. No negotiation with yourself. This rule is the wall that separates you from the ruin that claims 90% of traders. Trade selection demands surgical precision. You limit yourself to 3 to 5 setups maximum per day, and most days fewer than that. You are not a scavenger hunting for scraps in market noise. You are a sniper hunting for high-probability opportunities. If a setup doesn't qualify as A+, meaning clear trend structure, well-defined pivotal point, volume confirmation potential, and precise risk definition, you let it pass without regret. Position sizing follows mathematical discipline, not emotional impulse. You start every trade with 1% maximum risk. You never go big on a feeling or hunch. You earn the right to trade larger size by pyramiding systematically into positions that prove themselves through price action and volume confirmation. You let the market pay for your increased exposure rather than hoping your way into larger profits. Patience protocol requires accepting that if no clean setup meeting all criteria appears during market hours, $0 is a professional outcome. You will not manufacture trades to satisfy psychological needs for action or daily income targets. You value capital preservation more than the illusion of productivity. At month end, you conduct a comprehensive review process that ensures continuous improvement and prevents the behavioral drift that destroys accounts over time. Calculate total profit and loss for the month along with maximum drawdown, the largest peak-to-valley decline you experienced. This reveals whether your risk management held during emotional moments or if you violated protocols under pressure. Calculate your win rate and average risk-reward ratio. These metrics tell you if your edge is genuine or if you are fooling yourself with random outcomes. Track total number of trades taken. If this number creeps higher while profits stay flat, you are likely forcing marginal setups and need to tighten selection criteria immediately. Document your 3 biggest behavioral mistakes of the month. Not market mistakes, behavioral mistakes. Where did you violate your own rules? Where did emotion override process? Where did impatience cost you capital? This psychological inventory is more valuable than any technical analysis because trading is primarily a behavioral challenge disguised as an analytical one. Review account growth rate and consistency metrics. Are you compounding steadily or experiencing wild swings that indicate excessive risk-taking? Consistency is infinitely more valuable than occasional massive wins because consistency can be scaled systematically while volatility eventually destroys even large accounts. Only after proving 2 to 3 consecutive profitable months with disciplined execution do you even consider increasing your base position size beyond 1% risk. And even then, increases should be incremental, moving from 1% to 1.2%, not from 1% to 3%. Gradual scaling protects you from the psychological shock of larger position sizes while allowing your comfort zone to expand naturally. Here is the maxim that must guide every decision you make. Consistency compounds. Aggression implodes. The trader who generates steady 15 to 20% monthly returns will build substantial wealth over 2 years. The trader who swings for 50% monthly returns will blow up within 6 months. Every single time. No exceptions in the entire history of financial markets. The brutal reality that most traders refuse to accept is this: they want $300 tomorrow. They want the lifestyle without the discipline. They want the outcome without the process. They want to skip the boring foundation building phase and jump straight to the penthouse. Professionals understand that you build systems that deliver $300 averages in 90 to 180 days, not tomorrow morning. They build systems that deliver $500 averages in 6 to 9 months. They build systems that deliver $1,000 averages in 18 to 24 months. Your salary is not extracted from the market through daily quotas or desperate demands. It is earned through the discipline of cutting losses fast when you are wrong. It is earned by sizing small until the market proves you deserve to trade larger. It is earned by waiting through psychological discomfort for genuine pivotal points. It is earned by pressing winners aggressively when the tape confirms your thesis with price and volume. The $300 daily goal is not a target you aim at each morning. It is a byproduct that emerges naturally when you behave like a professional over sufficient time for edge and compounding to work their mathematical magic. It is the trailing exhaust of a well-tuned trading engine, not the fuel you pour in hoping to make it run. Tomorrow morning, when you sit down at your trading desk, do not ask, "Where is my $300? Instead, ask, "Where is my risk clearly defined? Where is my highest probability setup? Where is my discipline?" If you answer those questions correctly every day for months, the salary will build itself through the inexorable mathematics of professional behavior. You now have the complete psychological and mathematical framework to build a sustainable trading career. You understand why the amateur approach fails and how the professional model succeeds. You see the power of strategic weighting, the necessity of systematic risk control, and the explosive potential of disciplined pyramiding when applied to confirmed trends. But a framework needs specific tools to operate effectively. You need to know exactly how to identify those pivotal points we have discussed throughout this lesson. You need to understand how to read the tape, to recognize when institutions are entering versus when retail traders are distributing. You need the precise technical signals that tell you when to pyramid aggressively and when to exit into strength. That is exactly where we go next. In the following lesson, we will dive deep into the technical mechanics of tape reading and confirmation signals, giving you the tactical skills to execute the strategy we have just built together. We will transform this philosophy into actionable setups you can identify and trade starting tomorrow. You have the blueprint. Now let's get the tools to make it work.